Is the US economy about to crack? The evidence behind the headline. Something happened last week that almost every major financial news outlet got completely wrong. They zeroed in on one headline, a jobs number that looked strong on the surface, and they ran with it like everything in the American economy was just fine. But here's what they missed. Underneath that headline, the real engine of the United States economy, the American consumer, is starting to crack. And when the consumer cracks, nothing else matters. Not the jobs number, not the stock market, not the Fed's next statement, nothing. Because when the consumer stops spending, the entire economic machine begins to slow down, and the ripple effects touch every single corner of your financial life. I'm talking about retail sales that have just flatlined, discretionary spending that is falling off a cliff, inflation data that tells a complicated two-sided story, and a labor market that looks strong in the headline but deeply uncertain when you dig just one layer beneath the surface. Today on USA Economy. Today we are going to break all of this down, chart by chart, number by number, so that you walk away from this video with a crystal clear picture of exactly where this economy stands right now, and more importantly, what it means for your wallet, your investments, and your financial future before the Federal Reserve makes its next critical move. So if you've been feeling like something doesn't quite add up when you hear the rosy headlines, trust that instinct, because the data is telling a much more complicated story. Let's get into it. Let's start where the real story begins: consumer spending. Retail sales came in flat for December. That is not a minor footnote. That is a significant miss. Economists had been expecting a gain of around 0.4%, which is already a modest expectation. Instead, we got zero, nothing, a complete flat line. And when you put that next to November's 0.6% gain, what you see is a sharp and rapid deceleration in consumer momentum, heading right into the end of the year, which, by the way, is supposed to be the strongest spending season of the entire calendar year. Holiday shopping, end-of-year purchases, the final push before January. And yet, the consumer essentially stopped. When you look at the chart on retail sales over the past 12 months, the picture becomes even more telling. Earlier in 2024, we did see some brighter spots. March showed a decent uptick. June looked reasonably healthy. But here's the critical observation: neither of those moments of strength carried through. Both times, the momentum faded quickly. The consumer would perk up for a month and then pull back. And now, heading into the final stretch of the year, that pulling back has become the dominant trend rather than the exception to it. Now let's talk about what's inside that retail report, because the headline number is only the beginning. The core retail sales figure, the one that actually feeds directly into GDP calculations, slipped by 0.1%. That is not a rounding error. That is a contraction in the most important measure of consumer spending that economists and Federal Reserve officials actually use when they're assessing the health of the broader economy. Sales that exclude autos and gasoline also came in flat. And when you strip out those two volatile categories and you still can't find growth, that tells you something real and important about what's happening with the American household right now. But perhaps the most revealing detail in the entire report is what happened with discretionary spending categories. Furniture, down. Clothing and apparel, down. Electronics, down. Auto-related purchases, declining. These are the categories that people buy when they feel confident, when they feel financially secure, when they believe that tomorrow is going to be at least as good as today. Discretionary spending is essentially a real-time confidence indicator, and right now, that indicator is flashing yellow, possibly red. And here is why this matters so much more than people realize. Consumer spending accounts for roughly 70% of total US economic output. 70%. That means when the consumer slows down, not stops, not crashes, just slows down, the consequences ripple across the entire economy. Corporate revenues fall, businesses pull back on hiring, investment slows, tax revenues soften, and before long, what started as a soft retail sales report becomes a much larger and more complicated economic story. Small cracks in consumer spending have historically been some of the earliest warning signals of broader economic stress, and we are seeing those cracks emerge right now. The big question, of course, is whether this is just a temporary breather, a natural exhale after the intensity of holiday spending, or whether it marks the beginning of a more sustained and troubling pullback. That question does not have a definitive answer yet, but the trend is something we need to watch extremely carefully over the next 60 to 90 days. Now let's shift over to the labor market, because this is where the headlines were loudest last week, and where the disconnect between perception and reality is most stark. The economy added 130,000 jobs in January. On the surface, that sounds impressive. It was nearly double what economists had been expecting, and it was a dramatic improvement from December's revised gain of just 48,000. When you look at a bar chart of monthly job creation over the past several months, January's bar jumps out visually. It's hard to miss, and if you only look at that one bar, you walk away feeling pretty good about where things stand. Healthcare was the biggest driver of January's gains, adding 82,000 jobs on its own. Construction added another 33,000. Those are real, meaningful gains in sectors that reflect genuine economic activity. Healthcare hiring in particular tends to be relatively resilient, driven by long-term demographic trends rather than short-term economic conditions. So on the surface level, the labor market report looks encouraging. But here's where it gets complicated, and here's why context is absolutely everything when you're reading economic data. The 2025 payroll revisions. This is the detail that the financial media largely glossed over, and it might actually be the most important piece of information in the entire report. Full year 2024 payroll growth was revised sharply lower, down to just 181,000 jobs for the entire year. That averages out to roughly 15,000 jobs per month. 15,000. That is an extraordinarily weak number by historical standards, and it fundamentally changes how you should interpret the January figure we just received. When you look at the broader payroll chart across the full year, what you see is not steady, reliable growth. You see volatility. You see months with decent gains followed by months with negative or near zero readings. You see a pattern that does not suggest a labor market operating from a position of deep strength, but rather one that has been inconsistent, choppy, and subject to significant revision. And that last word, revision, is critical. The numbers we see in the initial report are often not the numbers that end up in the historical record. They get revised, sometimes dramatically, in the months that follow. And as we just saw with the full year 2024 data, those revisions can paint a very different picture than the original headline suggested. So yes, January's 130,000 gain looks strong, but we have to ask the honest question: can we actually trust this number at face value, given what we've seen in terms of how these figures get revised? History suggests we should be cautious. One strong month does not erase a weaker underlying trend, and trends ultimately are what matter when you're trying to understand where an economy is actually heading. Let's move to the unemployment rate, which actually did bring some genuinely positive news. The headline unemployment rate dipped to 4.3%, down from 4.4%. On the chart, you can see that the rate had recently peaked at around 4.5%, and it has now edged lower. It's not a dramatic drop by any means, but directionally, it is moving in the right way. The labor force participation rate also ticked up, reaching 62.5%, which means more Americans are actively engaged in the workforce, either working or actively looking for work. That's a healthy sign. Even more encouraging was the movement in the U6 underemployment rate, which is the broader measure that captures not just the unemployed, but also part-time workers who want full-time work and discouraged workers who have stopped looking entirely. That rate fell to 8%, which suggests that more people are finding better, more stable employment situations, rather than being stuck in underemployment or on the sidelines out of frustration. So when you put it all together, the unemployment picture looks reasonably stable. The rate is low by historical standards. Participation is moving higher. The broader underemployment measure is improving. These are not bad numbers. But here's the honest tension that we have to sit with. If the overall hiring momentum for the full year of 2024 was as weak as the revisions suggest, just 15,000 jobs per month on average, then how solid is the foundation that these unemployment numbers are sitting on? A low unemployment rate can persist for a period even as underlying labor market health deteriorates, simply because people exit the labor force or the math of the calculation shifts in ways that aren't immediately visible. The unemployment chart looks stable, but hiring consistency over the coming months will be the real test of whether that stability is genuine or somewhat illusory. Now let's talk about inflation, because inflation was absolutely central to the economic conversation last week, and it has direct implications for what the Federal Reserve decides to do next. The annual inflation rate slowed to 2.4%, down from 2.7% in the previous reading. That is meaningful progress. Earlier in 2024, inflation had been hovering closer to 3%, and it even touched 3% again in September before rolling over into year-end. The downward trend in the annual rate is clear and real, and that is genuinely good news for American households who have been dealing with the accumulated weight of elevated prices for several years now. A few specific components stand out. Energy was a major helper in December, with gasoline prices falling 7.5%. That's a significant decline, and it pulled the overall inflation number lower in a meaningful way. Shelter inflation, which has been one of the most stubborn and persistent components of the inflation picture, also moderated, coming in at 3%. That's still above where the Fed would ideally like to see it, but the direction of travel is encouraging. Now let's look at core inflation, which strips out food and energy to give a cleaner read on underlying price pressures. Core inflation slipped to 2.5%, which is the lowest reading since March of 2021. That is not a trivial milestone. It represents real, tangible progress in the multi-year fight to bring inflation back under control. And it suggests that the Fed's aggressive rate hiking cycle did, in fact, do a significant amount of the work it was designed to do. However, and this is the critical however that policymakers at the Federal Reserve are focused on right now, the monthly core price reading still came in at 0.3%. That means that while the annual trend is clearly improving, the month-to-month pressure has not fully disappeared. Price increases are still happening. They're just happening more slowly than they were a year or two ago. But 0.3% per month on core prices, if that pace continues, still annualizes to a level above the Fed's 2% target. And that matters enormously for the path of interest rates going forward. The inflation story is genuinely a two-sided one. The annual numbers are improving. Core inflation is at a multi-year low. Energy is helping. Shelter is cooling, slowly but meaningfully. These are all positives. But the monthly data reminds us, clearly and firmly, that we are not yet at the finish line. The last mile of inflation reduction has historically always been the hardest, and there is no reason to believe this cycle will be any different. So where does all of this leave us on interest rates? What is the Federal Reserve actually going to do? Let's lay out the full picture as it stands right now. On one side of the ledger, we have inflation that is moving in the right direction, with core inflation at its lowest level in nearly 4 years. We have an unemployment rate that is stable and even slightly improving. We have a labor market that, at least on the surface of January's report, showed a solid rebound. These are the factors that would, in a normal environment, give the Fed confidence that the economy is in a reasonably healthy place and that interest rates can potentially be reduced. On the other side, we have job growth that, when you look at the full-year revisions, was significantly weaker than originally reported. We have monthly core inflation readings that haven't yet convincingly broken below that 0.3% level. We have a consumer who is visibly pulling back on discretionary spending in ways that could have broader economic consequences. And we have a level of uncertainty around trade policy, around geopolitical dynamics, around the global economic environment that makes confident forward projections extremely difficult. Given all of that, the current market pricing suggests a 92% probability that the Federal Reserve holds interest rates steady at its next meeting. That means the vast majority of market participants and professional forecasters believe the Fed is not going to cut rates in the immediate term. They want more evidence. They want to see whether January's strong jobs number holds up in subsequent months, or whether it reverts toward the weaker trend we saw throughout 2024. They want to see whether monthly core inflation can sustain a move below 0.3%, and they want to see whether consumer spending stabilizes and recovers, or continues to soften in ways that suggest broader economic stress ahead. The Fed is in a genuinely difficult position right now. Cut too soon and risk reigniting inflation just as it's finally cooling. Hold too long and risk allowing a consumer-led economic slowdown to deepen unnecessarily. There is no clean, obvious answer, and that uncertainty is itself important context for how we should be thinking about markets, investments, and economic expectations in the months ahead. Let me bring this all together with the three most important things you need to take away from everything we've covered today. The first and most important takeaway is that the American consumer is sending a warning signal. The retail sales data is clear. The momentum that existed earlier in 2024 has faded. Households are becoming more selective, more cautious, more deliberate about where and how they spend their money. The pullback in discretionary categories, furniture, electronics, clothing, autos, is not a coincidence. It reflects real financial pressure that millions of American families are feeling right now. If this trend continues or accelerates, GDP is going to feel it. Corporate earnings are going to feel it. The labor market is going to feel it. This is the variable that matters most, and it deserves far more attention than the headlines are giving it. The second takeaway is that the labor market looks stronger than it actually feels when you dig beneath the surface. January's 130,000 gain is real, and it is encouraging in isolation. But the full-year revision for 2024 tells a story of a labor market that has been much weaker and more inconsistent than originally reported. One strong month cannot reverse a weaker underlying trend, and the volatility we've seen in monthly payroll figures makes it genuinely difficult to know with confidence how much strength actually exists in this labor market. The unemployment chart looks stable, and that's good. But we need to see several consecutive months of consistent job gains above 100,000 before we can confidently say the labor market foundation is as solid as it needs to be. The third takeaway is that inflation is making real progress, but we're not fully through the tunnel yet. The annual numbers are clearly improving. Core inflation at its lowest level in nearly 4 years is significant and worth acknowledging. But monthly core prices are still rising at a pace that keeps the Fed cautious, and the last stretch of the journey back to 2% target inflation has never been easy or linear. Energy and shelter are helping, and that is genuinely good news. But the Fed needs to see that monthly number sustain a move lower before they're going to feel comfortable reducing rates. So, what should you actually be watching for in the weeks and months ahead? What are the specific signals that will tell us whether this economy is stabilizing or deteriorating? Watch the retail sales report for February and March. Does consumer spending rebound, showing that December's flat line was just a temporary breather? Or does it roll over further, confirming that the consumer-led slowdown is accelerating? This is the single most important data point to monitor right now. Watch the monthly payroll figures. Do job gains stay consistently above 100,000? Or do we see the kind of volatility and weakness that characterized 2024 once the revisions came in? Consistency in hiring data will tell us far more than any single month's headline number. Watch the monthly core inflation reading. Does it sustain a move below 0.3%? Or does it remain stubbornly elevated, keeping the Fed's hands tied on rate cuts? This number will be central to every Federal Reserve conversation for the next several months. And watch the Fed's own communication. Listen to the language that Fed officials use when they speak publicly. Are they becoming more open to rate cuts? Or are they doubling down on the need for patience and further evidence of progress? Their words will shape market expectations long before the actual policy decision is made. Here's the bottom line. If consumer spending continues to weaken while inflation keeps cooling, rate cuts could come sooner than markets are currently pricing. That would be meaningful for investors, for borrowers, for anyone carrying variable rate debt or watching the housing market. But if inflation firms back up, or job growth stays genuinely strong and consistent, then the Fed stays on hold and the timeline for rate relief gets pushed further out. The data is speaking. The question is whether you're listening to the right story, not the convenient headline version, but the full, complicated, honest picture that the numbers are actually telling. That is what we do here on USA Economy Today. We cut through the noise, we look at the real data, and we give you the context you need to make sense of it all. If you found today's breakdown useful, please hit that subscribe button so you never miss our next analysis. Drop your thoughts in the comments below. I genuinely want to know what you think the Fed should do next, and whether you're seeing any of these economic pressures show up in your own spending and financial life. And before you go, check out the next video on your screen right now. It connects directly to everything we talked about today and goes even deeper on what's coming next for the US economy. As always, thank you for being part of the USA Economy Today community. Stay informed, stay sharp, and we'll see you in the next one.